IAS 28 is investment in associates and joint ventures. Actually, joint ventures we discussed in IFRS 11 as well. IFRS 11 actually talks about the classification and types of joint arrangements, which they are. But the accounting treatment we cover under IAS 28. So when you see IFRS 11, they would say that the accounting treatment will be done by equity accounting, and equity accounting is actually IAS 28. So joint arrangements, joint ventures, IFRS 11 defines the nature, but the accounting treatment will be done by equity accounting, and equity accounting is IAS 28. Our topic for today is not joint ventures. Actually, topic for today is only associate and how do we treat associates in the consolidation process. Now, before you already have started, we have learned that the control and the significant influence and what is a subsidiary, what is an associate. I do not want to go into a lot of detail, but you should remember that there was a rule which was like plus 51%, plus 50% when you call it a subsidiary, and you did full consolidation, which we said line by line consolidation under IFRS 10. And whenever you had shareholding between 20 and 50%, we called it significant. We called it associate. And in case of associate, we do not have control, but we have significant influence. We call it significant influence. Now, the thing is, this 20% and 50% is just one criteria. It is just one criteria, but this is not like the absolute rule. What you need to see is control. If control is there or if control is missing. Okay. If control is there, you call it a subsidiary and you do line by line consolidation. And if control is missing, then you call it an associate. Why I'm saying it? Because it is possible that sometime in exams they say that you have 20% ownership or you have 25% shares, and you immediately think that, oh, I have 25% ownership, so it must be an associate. Not necessarily. You need to see other information, because if they say that the company owns A company or B company owns 25% in C company, but then it says that it has 3 out of 5 directors. It has 3. The total directors are 5. Out of 5, they have 3 directors appointed. When you have 3 directors appointed, it means that you are the majority on the board and you have the control. So although it is 25%, but you still have got control. So you will not do equity accounting. You actually will be applying the line by line consolidation under IFRS 10. Now, that what I just explained to you, it is an exception. It does not happen always. It is an exception. Generally, when they say that it is 25% in exam or it is 20%, you would look for the 20% rule. Generally, whenever it is between 20 to 50%, you should normally consider that it is a case of significant influence and not the control. However, at the same time, just take a little bit care of seeing any other conditions if they tell you about giving control, because these are conflicting situations. So just be careful on that. So I'm assuming here that with 20% or with 25%, you do not have control and you are considered as an associate, and associate means significant influence. Significant influence means that you cannot control the decisions. You can only participate in the decision-making process. You understand? Taking the decision and participating in the decision are two different things. So control puts you in a position to take the decision. Significant influence, it only gives you a right to participate in the decision. That is called significant influence. So let's start today now. We say that topic, let's define an associate. I already have told you, an associate is a situation where you have significant influence, which means that you can only participate in the decision-making process, which comes to you from 20 to 50% of the equity shareholding. And we use equity accounting method, which is IAS 28. What is equity accounting method? I'm going to explain very simply. Prepare consolidated financial statements to include a single subsidiary and an associate. I don't want to cover this thing because we have prepared financial statements examples a lot. So definition, accounting treatment, and significant influence, and etc. Equity accounting, let's be very quick. What is equity accounting actually? When we say equity accounting, what comes to mind? It comes to mind that parent takes its percentage of profit from associates' profits and reserves. What does that mean? Equity accounting does not involve line by line or what you call full consolidation. See, when you had a parent and a subsidiary relationship where you had 51%, 60%, 80%, you do full consolidation. Full consolidation means, parent sales plus subsidiary sales, parent cost of sale plus subsidiary cost of sale, parent tangible assets plus subsidiary tangible asset, parent cash plus subsidiary cash, parent receivable plus subsidiary receivable. So the 2 income statements, you merge them. You merge the full 2 income statements and you merge the full 2 balance sheets. And all of the lines on the income statement and all of the lines on the balance sheet, you are adding them together. This is called full consolidation. This is called line by line consolidation. It is only done in case of when you have control. Okay. It is done in case of control when you have more than 50% or you are taking the decisions. But in case of significant influence, we use equity accounting. So we do not, so there is a company called associate. Gamma company is our associate. Gamma has some sales. I'm not going to add them into my balance sheet. Gamma has cost of sales. I'm not going to add parent cost of sale plus gamma cost of sale. It will not happen. Or parent tangible asset plus gamma tangible asset. It will not happen. You will not add the individual financial statements. You will not add line by line all the items. What you do, that you find out what is the profit of that associate. So gamma company has made a profit of $100,000. How much do you own? You own only 20%. So from that $100,000, 20% of $100,000 means $20,000. You take that $20,000 and add it into the parent. That's all. You only bring your $20,000 into the investment. So you don't. That is called equity accounting. Just like the last line of profit, you bring it back to the group. That's all. This is, and you do not consolidate the financial statements. We do not consolidate the financial statements. We just consolidate the profits and the reserves. This is, and that is very simple, by the way. It makes your life simple. You don't need to make a lot of adjustments. Few adjustments are needed, which we are going to discuss. But IFRS 10 full consolidation is a complex process. And by the way, you should remember, for associates, you do not add any goodwill also. If there's anything which you will pay extra, that will be added into the cost of investment initial. What do I mean? Let's suppose that there is a company called Gamma, and for Gamma, what happens that Gamma's own net assets, or Gamma's value, whatever it is, 100,000, okay, and 100K. You purchased only 20% of Gamma. So for 20%, logically, you should be paying only 20,000, but you paid 25,000. So you paid 25,000 to acquire 20% of 100,000. So it looks like that you are paying 5,000 more. Now, if it had been a subsidiary, this 5,000 you consider as goodwill and you show it separately. But in case of an associate, you do not show it at goodwill. You will just consider, you would say my cost of investment is 25,000. So this 5,000 which has been paid extra, it is not shown separately. It comes into the cost of investment. Double entry would be debit cost of investment 25,000, credit cash or credit bank, whatever you paid, however you paid. So you just put that 5,000 into that. You don't show it separately. Debit cost of investment, on the balance sheet of the parent and credit, cash or whatever. So remember that goodwill is purely a concept in case of a subsidiary, which means where you have the control. So anyways, we start with the topic, accounting for associates. Definition IS 28. An associate is an entity over which the investor has significant influence. Significant influence means that you can just participate in decision making, power to participate. That's all in the financial and operating decisions. In the exam, you should apply the 20% rule, but exception could be there. Just like I explained that generally when you see 20%, you immediately assume that it is a case of an associate. I'm going to do equity accounting, but you should be careful to see some exceptions. There could be some exceptions, like I told you, that if this, say you under some specific situation that you have 3 directors out of 5, or you have 6 directors out of 10. So 6 directors out of 10 means that you have 60% seats on the board. So when you have 60% votes on the board, it means that you are in control, but that is an exception. So IS 28 also states that significant influence can be shown by representation on the board of directors, but not majority. For example, if there are 10 and you are 2, so out of a total board size of 10, you have 2 directors, or maybe you have 1 director. It is significant influence. Participation in the policy making, not control, but just participation. Material transactions between the investor and the investee are happening. Interchange of managerial personnel. These are some signs of significant influence, obtaining the significant influence. Investors separate financials. When the investor separate financial means now it is like not the owner. Parent is not there, but we call it an investor. So when you are a P company, if you remember that P and Q, where P was parent and Q was a subsidiary. Q was the subsidiary. In case of subsidiary, the other one is called parent. In case of an associate, the other party is called investor. Now you cannot call yourself parent. Let's suppose that if this is P and P has invested 60% in Q, and then P has invested 20% in R. So for Q, P is the parent. We call it parent. But for R, P is just an investor because it is not the parent company. Parent would be someone else, because somebody else, for example, there is something S has invested 80%. So if I am R, I would see S as my parent and I would see P as my just investor. Okay. So you need to understand the word investor. So investor. So if you are here, you have just invested 20%. You cannot say that I am the parent of R. No, you are just an investor in R. Parent is someone else. So just as with the subsidiary, the investor can record the investment in the investee. Investee is gamma and investor is P in its separate financial statements, either at cost or at fair value. Both are allowed by, IFRS allows you both. You can measure them at cost, you can measure them at fair value. And this instructions will always be given in the question that P has a policy to measure investment in gamma at fair value, or P has a policy to measure investment in gamma at cost. It is always given in the question how you should measure. Both are allowed. Fair value means the market value and cost means initial cost, whatever you paid. So when you have this equity method, how do we show it in statement of financial position in your balance sheet? Now the balance sheet of what? Balance sheet of the investor. The investor will put it in non-current assets, number one, because it is a non-current asset. And how do you show? You say investment in associate in the beginning when you put money. So you say that, okay, cost of associate is here. The first thing when you purchase it, remember 25,000 you paid. So let's suppose, so you say 25,000 I paid. So this is my 25,000, okay, which is my initial cost. It is called initial cost. Then during the year, they made a profit. They made a profit of 100K, and from 100K, it's a too big profit. Let's call it. They made a profit of 20,000. 20K, and from 20K I have 20%. So 20K into 20%, 4,000 is my share of profit. Okay, so I just put it here. And then any impairment losses on associate, if there are any losses on if they have made an impairment. So let's suppose they're an impairment of gamma. It is possible that gamma has been impaired by 1,000. You should subtract it. And you say that my closing balance of associate is 29 and 28,000. So in the beginning balance, when you acquired this associate, you put it as 25,000 on acquisition, at cost, and end of the year it is 28,000. And these are not the only numbers actually. What you need to understand that if they have paid out some dividends, because it is possible that your share of profit is 4,000 and they have given you dividends. So if they have given dividends, you should also subtract that. You cannot say that I own 20,000 because 4,000 profit was made, but they also gave you 2,000 dividend. So if you have received any dividends, you should subtract it from here, and you should say that my cost is not 20, my closing investment is not 28, my closing investment is just 26. Okay, so this is very simple logic, like opening balance of investment, add your share in profit and reserves, whatever. Maybe there are some profits and there are also some reserves. So take your share, add it there. If there is any impairment, you should subtract. And if there is any, dividends received, those should be also be subtracted. Now, sometimes what happens? Now, this is not going to happen with you actually. I don't expect that in exam they will give you such a situation, but let's see like this. Let's suppose that there are losses, okay? In this year, there's a $5,000 loss. There is no profit. They don't make a profit, they make a loss. So you will make it like this, and this becomes 20, okay? So next year, you will come back to 20, and they make another loss of $10,000. I mean, they don't make a loss of 10, actually they make a bigger loss. The share of your loss is 10,000. From the total loss, you take 20% of your share, so your investment will become only 10. In next year, your value of investment in your balance sheet is 10, and they make a big loss, and the share of your profit, your loss, is 15,000 because you are 20% owner. So let's suppose that they made a loss of, I don't know, say 80,000. From 80,000, 20% if I take, it makes it 16,000. Should I put it 16,000 like this and show my investment as -6? Answer is no, it will not happen. You will only take it 10 your loss and you will make it 0. So in this investment, if it is not a profit-making investment, if it is a loss-making investment, it is going to decrease in your balance sheet until it becomes 0. You will not take it into negative because investments are not in negative. You just get rid of that thing. That's all. You say my investment has become 0, so you don't take it into negative. This is something you should remember. I don't expect, I've never seen this thing coming into ACCA F7 or SBR or DIFR. I've never seen this thing happening, but you should know that investments cannot be negative. So this is one simple. Now this is primarily, but there are few more adjustments which we need to learn. And then you come about to your income statement, like when you prepare consolidated statement of profit or loss, because this is about, the value of the investment in the balance sheet, how the opening and closing investment is shown in the statement of financial position of the investor. Now, investor has income statement as well. So what we do with the income statement, you just take your profit or loss. You have your A's profit or loss for the year into group percentage. So whatever is associate, A means associate profit multiplied by group percentage, whatever you have, take that that profit shown before group profit before tax. You show it before profit and tax because you have to pay taxes on that. Then you have other comprehensive income is OCI multiplied by group OCI, group percentage, and add it into the group OCI. So you have, profit and loss, and just remember, add it before the group profit, because whatever you are earning profits from here, you have to pay taxes on that. Then this comes up. Points to note: associate is not in a group company, and so no cancellation of intra-group transactions is performed. So intra-group transactions, if you remember, any receivables and payables between parent and subsidiary, you have been doing them, cancelling them out. You will not do that. Or maybe there were some other transactions, intra-group loan received, loan paid, interest received, interest paid, etc. Nothing will be done. Intra-group sales are not eliminated. Yes, we do make some adjustment for unrealized profit that I will show you. But generally, when you remember group sales, parent sales plus subsidiary sales minus intra-group sales. You never say parent sale plus subsidiary sale plus associate sale. You never say that plus associate sale. You always have group sales is equal to parent sales plus subsidiary sales minus intra-group sales, because I am not doing line by line consolidation on associate. So I'm not consolidating associates, sales, cost of sale, admin expenses, distribution expenses, taxes, finance cost, etc. We are not consolidating. So no intra-group elimination will be done. However, to avoid double counting, the investor's share of unrealized profit, only this thing you need to make adjustment. Unrealized profit and losses on transactions between the investor and the associate are eliminated in the same way as for the group account. So you are not doing the sales and cost of sales stuff, etc. What you are doing is only eliminate the intra-group profits, unrealized, those unrealized. Otherwise, it will be double counting. What does that mean and how to do it? Let me show you. The adjustments are if the sales is by the associate. Let's suppose that Gamma, the associate, is selling to the parent. So the unrealized profit is lying within the associate. Where is the unrealized profit? Let's suppose Gamma sold goods to parent and parent has not sold them yet. So the profits were recorded within associates profits. The profit from these transactions are in associates total profit, and that include unrealized profit. So here what you do, debit cost of sale of A, which is mean associate, group retained earnings, which we will bring it later on, and credit group inventories. So group, because the parent purchased goods, this was Gamma, and Gamma was an associate, he sold goods to B. So Gamma purchased goods for 100 and Gamma sold goods to 150 here. So what is happening, that the parent is showing inventories at $150, and this includes actually $50 of profit, which is unrealized. So when we show the group inventories, we should credit group inventories with $50. And this is $100 here. He was showing his sales here 150, and this is with here we increase the cost of sales. Whatever is the cost of sale, when you add 50 into the cost of sale, so this will be means that profit will be reduced, and this is the purpose, because this is unrealized. So this is one adjustment you make too. So debit cost of sale of A. So A cost of sale means associate cost of sale you will increase, and group inventory you will decrease. This is the first adjustment, which is important. The convention is to increase the cost of sale of the seller, which is associate, and so when we debit cost of sales of A, we actually debit the share of associate's profit line. We are actually decreasing the associate profit because this profit is unrealized. Then if the goods are sold by not associate, here it is associate is selling the goods. Okay. Second scenario could be where the sale is by the parent, the investor is selling the goods. Like again, I say that this time this is P and this is Gamma, and this time P is selling goods. So P purchased some goods for 100 and P sold these goods for 150 and making a $50 profit, which is lying here. $50 now lying in the parent. So debit cost of sale of P group. So debit cost of sale of P, okay? Not the cost of sale of associate, cost of sale of P. So P cost of sales are increased, and you say credit investment in associate. This time not inventories, investment in associate. Whatever you had investment, remember investment in associate, you said opening investment 25,000 plus profit we made 4,000. Associate made a profit of 4,000. And from that you should decrease that profit. Investment in associate is credited by $50. And here we debit the investment in associate rather than group inventories, because A holds the inventories. Inventories are with A, which is associate. Because if you see that, where are the inventories? Inventories are lying here. Inventories are lying here, but I'm not consolidating the inventories. If I had been consolidating the inventories, I would have decreased inventories, because from here I'm not consolidating inventories, I'm consolidating my profits from here. So I just decrease the profits. And profits are reflected in investment in associate. And the value of the adjustment at all time is the group percentage, whatever is 20%, 30% of unrealized profit amount. So there is an unrealized profit, and how much of that, by the way? So I actually, sorry, I just ignored one thing to mention here, that this was 150. So unrealized profit is 50. You should not be doing 50, by the way. I just ignored. You should be multiplying it with the group percentage. Let's suppose that you are 20%. So you should be making adjustment for not $50, but 15 to 20%, which is $10. So in the first transaction, which I did before, when the parent was selling or when the associate was selling, every time you will make adjustment for $10, okay? Because this is the group share. Total unrealized profit is 50, but out of 50, what belongs to the parent? That is 10. So this is all about associate. Just a few quick revision of the concepts which we already discussed. Subsequently, after the initial recognition, the carrying amount of the subsequent recognition, carrying amount of the investment, initially it was 25K, like which I said in the beginning, we purchased it for 25, is increased or decreased by the investor share in investee's net profit or loss. If you made profit, you add 4,000. If you made some loss, you subtract that amount or loss after the acquisition date. The journal entry is debit investment in the financial position and credit income from the associate in profit or loss. So this is the double entry. You should remember debit investment, because when you are increasing investment, it means debit investment, and credit the income from associate within the profit and loss before the tax amount, before TDIT, okay? And or vice versa, when an associate made a loss, then if it makes loss, then debit the income from associate, which means loss from associate, and credit the investment. So it is just the opposite. Dividends are received sometime. When an investee distributes some dividends to the investor, then such a distribution decreases the carrying amount of the investment. If you remember from the first slide, I said 25K initial cost plus 4,000 profit minus 1,000 impairment loss and minus 2,000 dividends. If dividends are received, those dividends should be subtracted from your closing investment value. That's all. And the double entry is debit cash and credit investment. When you say credit investment, it means that you are subtracting your investment amount. Remember, I just made it, like I said, 25K on the top, then you made 4,000 profit, then you made 1,000 impairment loss, and you made 2,000 dividend received. So credit investment. Whenever you make credit, it means that you are subtracting because it is an asset. And debit cash or debit bank, whatever way they give you the dividends. So dividends will essentially effectively decrease the closing value of the investment. So this is all short standard. Actually, we have done this thing while doing questions from consolidation. We did some long questions from consolidation, and we practically applied this thing. But I just felt that maybe we should make a separate video for that, so that you know that okay, it's a separate topic and it is there. So that's all, nothing more. For your F7, SBR, or IFR level, for SEC level, this much of knowledge should be enough from associates.